New York Times columnist Jim Stewart is with us. It's great to have you, Jim. Good
Nice
morning.
to be here. Hi.
What has struck you about what tech has done on headcount so far?
Well, what has really struck me is the focus has been so much on the big tech layoffs, and understandably, because these are like highly educated, highly paid, very articulate young people, but the overall unemployment numbers are incredible. Tens of thousands being, laid off in the tech sector, but we're at an unemployment rate that's at a, tied for a 50-year low. It's like, 3.5%, which is extraordinarily low. In some states, it's like 2%. So the slack is being taken up. There's huge demand for workers, but it's in this narrow, highly interest rate sensitive tech sector that we're seeing the steepest cutbacks.
Last week, we did see it bleed into Dow Chemical or Dow, IBM a little bit, but some non-Hasbro, some non-tech firms. Do you think that has more to go?
Quite possibly. I think it's the very large companies that are more sensitive to the macroeconomic factors, and so some of them, I think, anticipating a slowdown or paring back. Certainly, the big companies that are media dependent, that are advertising dependent, there's definitely been a pullback on companies willing to spend there, so they're pulling back a little bit. But like I said, somebody else is hiring all these people. And another thing I find kind of interesting is that in the employment food chain, a lot of these workers, especially the tech workers, are some of the most highly paid, best educated. They're not going to have any problem finding another job. It may not be as high paying, and they can't roll out of bed and get like 6 tech offers. So it's kind of filtering down through the food chain, but they're not like leaving and going to work at Starbucks.
We've seen structural changes to the labor market, right? I mean, you've seen baby boomers retiring out and others retiring out of the market. Obviously, immigration and some of the limits there with visas and the like has continued to play a role over the last couple of years as well. It just raises the question in a week where the Fed is meeting again on how much can actually be done by monetary policy to loosen the labor market, given the fact that there seems to be very structural and very secular in terms of some of the dynamics that we're talking about.
Yeah, I think there are limits to what monetary policy can do, but it clearly is having an effect. I mean, partly because, the valuation models for these high growth companies are very interest rate sensitive. And so as their stocks are coming down based on diminished future expectations, they're sort of looking at these hiring sprees and, trimming their own workforce. So I think it definitely does have an effect. And I think so far, I would guess they've got to be pretty happy with this. I mean, the super overheated job market is clearly easing off. You're not seeing the huge wage gains. So the inflationary pressures are sort of coming down, and yet still with a very low unemployment rate. I'm sure they wouldn't be sorry to see that 3.5 creep up to around 4 or something, but that's a very healthy economy and nowhere near a sort of recessionary environment.